All right, let's talk about a stock that has Wall Street completely split down the middle, SoFi. This is one of those fintech darlings that's had a monster run, but now it's facing some very serious accusations. So let's get right into it. And really, it all boils down to this single question. Is SoFi this incredible high-growth company that's about to change the world of finance? Or is it a total house of cards, just propped up by some creative accounting and waiting for a gust of wind? The two stories could not be more different. And this slide really sets the stage for the battle we're seeing. In one corner, you've got this absolutely scathing short seller report that basically sent the stock into a freefall. But in the other corner, you have a framework from an investing legend, Peter Lynch, that actually suggests SoFi is a fantastic bargain right now. So let's unpack both sides of this tug of war. Okay, first up, let's tackle the bear case. What are the specific fears that are making investors hit the sell button? Because as you'll see, it's not just one thing. The biggest, darkest cloud hanging over SoFi right now is definitely the Muddy Waters short report. It makes some really serious claims. It says SoFi is using aggressive accounting to basically make its loans look way healthier than they are. The report claims the real rate of loans going bad, that's what we call the charge-off rate, is actually more than double what SoFi is telling everyone. And it points to other complex issues like unrecorded debt. For a financial company that's built on trust, these are exactly the kinds of accusations that can seriously spook the market. But SoFi's management did not take this lying down. The CEO, Anthony Noto, he came out swinging. He immediately called the report inaccurate. But he didn't just stop with words. To prove he had skin in the game, he made a very public move. He bought $500,000 worth of SoFi stock right after that report dropped. And that's a classic sign of confidence, right? You know the old saying, insiders might sell for all sorts of reasons, taxes, buying a house, but they usually only buy for one reason. They think the stock is going way up. But it wasn't just the short report causing problems. You had other headwinds piling on. The stock had an insane 70% run-up in 2025, so some people were bound to take profits. The valuation also got pretty pricey, with a price-to-earnings ratio hovering around 50, which is super high for a financial company. Throw in some technical weakness on the stock chart and a big capital raise that got people worried about their shares getting diluted, and, well, you've got yourself a perfect storm of bearish sentiment. So that's the fear. That's the bear case. Now let's completely flip the script and look at the total opposite perspective, the bull case. And a great way to frame this is by using the philosophy of the investing legend Peter Lynch. Peter Lynch had these different categories for stocks, and SoFi fits perfectly into a type he absolutely loved, the fast grower. These are those aggressive, young companies that are just growing at a dizzying pace. Think 20 to 25% a year. For these stocks, Lynch's advice was simple. Ignore dividends, don't worry about them, focus only on earnings growth. But he also gave a warning. The big risk here is that these companies can burn out just as quickly as they rise if that growth story ever stumbles. And when you look at SoFi's numbers, man, it fits the profile almost perfectly. Its revenue is projected to grow at a 24% annual clip, smack dab in that Peter Lynch sweet spot. And what's even crazier is that its adjusted earnings are projected to grow at a blistering 40% rate. This is the textbook definition of a fast grower, and it's really the heart of the entire bull argument. So how did Lynch figure out if these companies were a good buy? His favorite tool was something called the PEG ratio. It sounds complicated, but it's super simple. You just take the PE ratio and divide it by the earnings growth rate. So for SoFi, a PE of around 30 might seem high on its own, but when you divide that by a growth rate of 35%, you get a PEG ratio of about 0.8. And here's the key. According to Lynch, a PEG of 1.0 means a stock is fairly priced. Anything under 1.0, he considered that a bargain. And if you want a simple way to remember it, Lynch himself summed it up perfectly with this quote. He believed that for any company that's fairly priced, its PE ratio should be about the same as its growth rate. And since SoFi's growth rate is higher than its PE ratio, well, a Lynch-style investor would look at this recent price drop and see a major buying opportunity. Okay, so that's the theory, that's the Peter Lynch model. But what happens when we look at it in practice? What do independent third-party analysts think SoFi is actually worth? Well, the independent research firm Morningstar went and crunched all the numbers, and their analysis put SoFi's fair value at almost $23 a share. Now, given that the stock has been trading recently around $17, that suggests a potential upside of over 30%. But Morningstar's analysis isn't just a simple thumbs up. It's nuanced. While they do rate SoFi as undervalued, they also give it no economic moat, which means they don't think it has a killer, sustainable competitive advantage just yet. They also flag the uncertainty here as very high because of risks like interest rates and the credit cycle. So what's their final verdict? They basically think the market is panicking about short-term noise and totally ignoring the company's long-term potential. This table really puts it all together visually. You can see the current price, around $17, is trading at a pretty big discount to both the Peter Lynch-based value and Morningstar's fair value estimate. And just look at how far it is from its 52-week high. That really shows you just how dramatically the sentiment around this stock has shifted. So, after all that, where does this leave us? Let's zoom out for a second and look at the potential path forward, maybe out to the year 2030, based on a few different ways this could all play out. If we project SoFi's growth out into the future, you can see a pretty wide range of possibilities. In a conservative case, say with 20% annual growth, you're looking at a 2030 price target over $22. The base case, which is kind of in line with what analysts are thinking now, points to a price over $32. And in a really aggressive, optimistic scenario, the stock could climb north of $40. So when you boil it all down, here's the crucial takeaway. The SoFi story is a classic battle. It is short-term fear driven by a really damaging report and a weak market fighting against the long-term fundamentals of a super fast-growing business that by some classic valuation metrics looks deeply undervalued. The bears see a company with a foundation that might be shaky. The bulls see a future giant in the financial world that's on sale. After seeing the evidence for both the fear and the fundamentals, the final question is really for you. Where do you think this story goes from here?